bank collapse, subprime mortgage crisis, credit crisis, government bailout. Throughout the fall of 2008, phrases like these frequently appeared in headlines. This time period is among the most disastrous in the history of the American financial markets. Those who experienced these things are likely to never forget the chaos. Between mid-2007 and early 2009, the world's financial markets and banking systems experienced extreme stress. A decline in the U.S. housing market during the global financial crisis served as a catalyst for a financial crisis that spread from the U.S. to the rest of the world through linkages in the global financial system. Many banks experienced significant losses and needed assistance from the government to stay afloat. As the major advanced economies went through their deepest recessions since the Great Depression in the 1930s, millions of people lost their jobs. Additionally, compared to prior recessions that were not accompanied by a financial crisis, the recovery from the crisis was much slower. So what exactly happened and why? Keep watching to find out how the explosive growth of the subprime mortgage market, which started in 1999, significantly contributed to laying the groundwork for the chaos that would take place just 9 years later in the 2008 housing market crash and the 2008 stock market crash.
The financial crisis was the result of government housing policy.
There was a whole list of issues that have been building up. Syndicated leverage lending, which is literally 5 to 10 times what it is today, was a problem. The quant funds were over-leveraged. The investment banks were leveraged 30 to 40 to 1, which is far more than it was before.
People at the top were writing mortgages that they knew they'd never have to hold, so they'd sell them to somebody in Norway after they'd been put in a package. And you had people refinancing, figuring that didn't make any difference whether the monthly payments were too high, and you had them lying on loans, and you had the lenders participating in it.
Subprime mortgage borrowing increased starting in 1999 as the U.S. government-sponsored mortgage lender, Federal National Mortgage Association, launched a concerted effort to increase home loan accessibility to those with lower credit and savings than lenders typically required. Subprime mortgages are loans given to borrowers with less than ideal credit and insufficient savings. Historically, potential homebuyers found it difficult to obtain mortgages if they had below-average credit histories, provided small down payments, or sought high-payment loans. Unless protected by government insurance, lenders often denied such mortgage requests. While some high-risk families could obtain small-size mortgages backed by the Federal Housing Administration, others facing limited credit options rented. In that era, homeownership fluctuated around 65%. Mortgage foreclosure rates were low, and home construction and house prices mainly reflected swings in mortgage interest rates and income. High-risk mortgages started to become available in the early and mid-2000s from lenders who funded mortgages by repackaging them into pools that were sold to investors. To distribute these risks, new financial products were used, with the majority of subprime mortgages being financed by private label mortgage-backed securities because they were insured by brand-new financial instruments, or because other securities would first absorb any losses on the underlying mortgages. The less vulnerable of these securities were seen as having low risk. Due to this, more first-time homebuyers could get mortgages, and the number of homeowners increased. While many saw great prosperity as the subprime market began to explode, others began to see red flags and potential danger for the economy.
I called up the prospectuses and I read the prospectuses and I looked at these pools. I could see the credit standards within these pools deteriorating just quarter to quarter.
How could you tell that?
There was essentially crappier mortgages being put into these pools, and it didn't seem investors seemed to care, and it didn't seem the ratings agencies seemed to care.
The resulting demand bid up house prices, more so in areas where housing was in tight supply. This induced expectations of still more house price gains, further increasing housing demand and prices. Investors purchasing private label mortgage-backed securities profited at first because rising house prices protected them from losses. When high-risk mortgage borrowers could not make loan payments, they either sold their homes at a gain and paid off their mortgages, or borrowed more against higher market prices. Because such periods of rising home prices and expanded mortgage availability were relatively unprecedented, and new mortgage products' longer-run sustainability was untested, the riskiness of private label mortgage-backed securities may not have been well understood. On a practical level, risk was off the radar screen because many gauges of mortgage loan quality available at the time were based on prime rather than new mortgage products. Elliott Wave International's founder, Robert R. Prechter Jr., frequently argued that the overheated mortgage market posed a threat to the American economy because the entire sector was dependent on rising property values. As of 2002, Fannie Mae and another government-sponsored mortgage lender, Freddie Mac, had extended more than $3 trillion worth of mortgage credit. Prechter claimed that confidence is the only thing holding up this giant house of cards in his 2002 book Conquer the Crash. Both Fannie Mae and Freddie Mac have the responsibility of buying back mortgages from the original lenders in order to profit from the settlement of mortgage notes. Thus, these two businesses saw their revenue drastically decline as a result of rising mortgage default rates.
Too big to fail. And essentially that's what Freddie and Fannie became. And everybody had said that all along, and sure enough, they were too big to fail, and the implications of that were harmful.
The interest-only ARM and the payment option ARM were two of the subprime mortgages with the highest risk of harm. Both mortgages had adjustable rates. With these mortgages, the borrower is able to make much smaller down payments than would be necessary with a fixed-rate mortgage. These ARMs reset after a certain amount of time, frequently just 2 or 3 years, and frequently at higher rates. The payments then fluctuate as frequently as monthly, occasionally resulting in payments that are significantly larger than those that the borrower initially made. These mortgages were essentially risk-free in the rising market and expanding housing bubble that existed from 1999 to 2005. Due to the fact that borrowers' homes have appreciated in value since the purchase date, they may still end up with positive equity despite making low mortgage payments. After their mortgage rates reset, they could simply sell the homes for a profit if they were unable to afford the higher payments. However, many claim that these imaginative mortgages were disasters waiting to happen in the event of a downturn in the housing market, which would leave owners with negative equity and make it impossible to sell.
They're mortgage bonds supported by pools of loans, and most of the loans are what are called negative amortizing interest-only loans, which means that you, the homeowner and buyer, you borrow the money, and you not only don't have to repay your principal, you don't even have to repay the interest. And if you just don't pay anything, they just add to your loan.
So you can't lose your house.
You can't lose your house, right? In theory, right?
Total consumer debt in general continued to increase at an astounding rate, which added to the potential mortgage risk. Consumer debt reached $2 trillion for the first time in 2004. With the rise in housing prices, commercial investors started to favor the mortgage-backed securities market. A collection of mortgages is gathered into a single security called a mortgage-backed security. The premiums and interest payments made on the individual mortgages contained in the security benefit investors. As long as home prices rise and homeowners continue to make their mortgage payments, this market will continue to generate significant profits. But as housing prices started to fall and more homeowners started to fall behind on their mortgage payments, the risks became all too real. Few understood at the time how volatile and complicated this secondary mortgage market had become.
You basically just had a huge speculation in housing, and 50 million of the 75 million owner-occupied homes in the United States were mortgaged. 25 million were free and clear, so they were okay. But you literally had a crash in the value of something that 50 million families owned on margin, had thought were going to go up. They based their living standards on it. In many cases, they borrowed against it. And it was unlike any widespread financial
During this time, the credit derivative, also known as a credit default swap, was another well-liked investment vehicle. Credit default swaps were created as an insurance-like method of hedging against a company's creditworthiness. The credit default swap market, however, was unregulated, in contrast to the insurance market. This implied that the issuers of credit default swap contracts were not required to keep sufficient funds in reserve to cover payments in the event of a worst-case scenario, such as an economic downturn. When American International Group, one of the top financial institutions in the country, couldn't meet claims and announced significant losses in its portfolio of underwritten credit default swap contracts in early 2008, this signaled potential disaster for American International Group. By March 2007, Bear Stearns had failed due to huge losses resulting from underwriting many of the investment vehicles linked to the subprime mortgage market. It became evident that the market was in trouble and the subprime mortgage crisis was looming. Homeowners defaulted at high rates as the creative variations of subprime mortgages reset to higher payments as home prices declined. When house prices peaked, mortgage refinancing and selling homes became less viable means of settling mortgage debt, and mortgage loss rates began rising for lenders and investors. In April 2007, New Century Financial Corp., a leading subprime mortgage lender, filed for bankruptcy. Shortly thereafter, large numbers of private label mortgage-backed securities and PMBS-backed securities were downgraded to high risk, and several subprime lenders closed. Because the bond funding of subprime mortgages collapsed, lenders stopped making subprime and other non-prime risky mortgages. This lowered the demand for housing, leading to sliding house prices that fueled expectations of still more declines, further reducing the demand for homes. Prices fell so much that it became hard for troubled borrowers to sell their homes to fully pay off their mortgages, even if they had provided a sizable down payment. As a result, two government-sponsored enterprises, Fannie Mae and Freddie Mac, suffered large losses and were seized by the federal government in the summer of 2008. Earlier, in order to meet federally mandated goals to increase homeownership, Fannie Mae and Freddie Mac had issued debt to fund purchases of subprime mortgage-backed securities, which later fell in value. In addition, the two government enterprises suffered losses on failing prime mortgages, which they had earlier bought, insured, and then bundled into prime mortgage-backed securities that were sold to investors. Homeowners were upside down. They owed more on their mortgages than their homes were worth and could no longer just flip their way out of making the new higher payments. Instead, they lost their homes to foreclosure and often filed for bankruptcy in the process. The subprime meltdown was taking its toll on homeowners and the real estate market. The financial markets rose throughout the month of October 2007 despite what appeared to be a mess, with the Dow Jones Industrial Average reaching a closing high of 14,164 on October 9. Eventually, the unrest caught up, and by December 2007, the U.S. had entered a recession. The Dow Jones Industrial Average would trade below 11,000 for the first time in more than 2 years by early July 2008. However, the decline would still continue after that.
I did see in the summer of 2008, I got a call from one of the top officials of one of the main Wall Street firms trying to sell us many billions of dollars worth of equity securities in Freddie Mac, and I knew something was wrong.
On September 14, a week later, Lehman Brothers, a major investment banking company, failed due to its own overexposure to the subprime mortgage market. It declared the biggest bankruptcy filing ever made in United States history. Markets collapsed the following day, and the Dow closed at 10,917, down 499 points. On September 16, 2008, as a result of Lehman's failure, the reserve primary fund's net asset value dropped under $1 per share. Investors were informed that they would only receive 97 cents for every dollar invested. It was only the second time in history that a money market fund's share value had broken the buck due to the holding of Lehman Brothers commercial paper. Massive redemption requests were made as a result of the money market fund industry's subsequent panic. The largest brokerage firm in the country, Merrill Lynch, was purchased by Bank of America on the same day. Due to the aforementioned credit derivative contracts that American International Group had underwritten, their credit rating was also reduced. On September 18, 2008, rumors of a government bailout started, which caused the Dow to rise 410 points. The following day, Treasury Secretary Henry Paulson suggested creating a troubled asset relief program with up to $1 trillion available to purchase toxic debt and prevent a full financial collapse. The Securities and Exchange Commission started a temporary ban on shorting the stocks of financial companies on this day as well, in an effort to calm the markets. The Dow rose 456 points to an intraday high of 11,483 as the market soared in response to the news, ultimately closing up 361 at 11,388. The government took several steps intended to lessen the damage. One set of actions was aimed at encouraging lenders to rework payments and other terms on troubled mortgages, or to refinance underwater mortgages, loans exceeding the market value of homes, rather than aggressively seek foreclosure. This reduced repossessions whose subsequent sale could further depress house prices. Congress also passed temporary tax credits for homebuyers that increased housing demand and eased the fall of house prices in 2009 and 2010. To buttress the funding of mortgages, the Congress greatly increased the maximum size of mortgages that FHA would insure. Because FHA loans allow for low down payments, the agency's share of newly issued mortgages jumped from under 10% to over 40%. The Federal Reserve, which lowered short-term interest rates to nearly 0% by early 2009, took additional steps to lower longer-term interest rates and stimulate economic activity. This included buying large quantities of long-term Treasury bonds and mortgage-backed securities that funded prime mortgages. To further lower interest rates and to encourage confidence needed for economic recovery, the Federal Reserve committed itself to purchasing long-term securities until the job market substantially improved and to keeping short-term interest rates low until unemployment levels declined, so long as inflation remained low. These moves and other housing policy actions, along with a reduced backlog of unsold homes following several years of little new construction, helped stabilize housing markets by 2012. Around that time, national house prices and home construction began rising. Home construction rose off its lows, and foreclosure rates resumed falling from recession highs. By mid-2013, the percent of homes entering foreclosure had declined to pre-recession levels, and the long-awaited recovery in housing activity was solidly underway.